Hello, let's look at this week's data. First, we'll take a look at the long-term ATR percent, and that's been out of the market for quite some time. This is a blow up of our signal down here, and we're simply showing that we climbed, getting closer and closer to when it would say it's good to go back in the market, but then over the last few days, it's turned back over and headed down again. So clearly our long-term timer is not going to trigger anytime soon. This is showing many different things all on one chart. It looks confusing, but take them one at a time. This is the S&P. These are bonds. The 60/40 is the typical mix you get from any retirement target fund. It's also what most brokers you'll end up with after a while. If they start you with different kinds of stocks, by the time you've been with them for a while, you'll have a mix of stocks that will mimic the S&P. The same with your bonds. And then they'll also get you close to the 60/40. So this is what the typical investor is getting for quite some time. Less than 10% a year, and still subject to some fairly exciting drawdowns. Berkshire Hathaway is nothing to be proud of, really. Yeah, he beats the S&P. Big whoop. He doesn't beat the Nasdaq. Not not at all. Anybody that's just buy and hold Nasdaq is doing better than Berkshire Hathaway. It's over the last you know, 18 years or so. So he gets most of his glory from old times, old days, but the market changed after 2006, and a lot of the old timers didn't. All these things in red are easy ways to time the market. Uh, in and out on a 85-day moving average, a 200-day moving average. These are different ways. A 500-day over a 200-day, any of them are easy to do and fairly good and way better than what you're going to get with a brokerage. So you don't want to listen to anybody's advice. You can simply set up a moving average and do quite well. Now, if you're clever and know how to test your moving averages, you would find out that the QQQ with a 200-day moving average does fairly good here. It cuts your risk way below what the typical broker's going to run through you, and you make more than the S&P, not as much as the Nasdaq though. Super clever people know that if you do a 17-day linear regression crossing a 186-day moving average, you get, boom, an eensy bit below the Nasdaq for the 15% a year and a drawdown of only 20%. This is a fantastic formula that has run just great since 2006. Everything is green is some formula that I've come up with. And the three we use are the 200-day percent moving average. That's what percentage of the stocks in a particular index are above their 200-day moving average. The average true range percent system we have, and then the volatility on the VXN, which is the volatility measurement of just the NASDAQ 100. The week from such a high level has got me cash on stocks again. I think that trouble's coming. There's nothing wrong with sitting in cash. Anybody that's been here a long time knows that you're not missing anything. Yeah, we every time we jump out, it seems like the market wants to recover and everybody kicks themselves for a few days, and then troubles set in. And most of the time, very, very accurate when we say we want to get out of the market. The thing of it is, you can be wrong for a day or so, and if you're wrong, all the signals reverse and you come back in and you haven't lost any money, not at all. What you do is you get out of the market when there is a monster crash. And we have done that absolutely 100% of the time since 2000, since before 2006. Every major crash we have avoided. Yes, we've also been in and out of times when there isn't a crash, but that doesn't matter. We keep track of our overall money, and we're way, way, way ahead with very little risk. So I've sold all my Qs, but I'm still holding on to, for right now, a little bit of our gold and our gold miners, junior gold miners, to see if they kick off while we are sitting in cash. Our disclaimer, yeah, this is for educational purposes, not to be confused with financial advice. The ATR timer had a 2006 sell back here, and it's still a sell. And so it's a 60% return, and that sits there until we come back in the market and start over again. The last 15 trades, we've lost no money. This is our best timer here. So over since 2006, we've run an average of 19% a year with a drawdown of slightly less than 13%. That is considered unbelievable, a modern miracle. Now that's said sell, and we overrode that signal and jumped in a bit, and we rode it for a little bit, but now we're going to go ahead and go back out because that signal still sell, and it's getting weaker, not stronger. It's not looking like it's going to hit buy before it actually hits another sell signal. So we're out. On the VXN timer, we were up around 66, and now it's deteriorated to 63. So yeah, that's been dropping off. It still says to stay in the market, but I think we're going to get out and sit on the sidelines for a while and see what's going on. As we have talked about before, the average true range percent timer looks at the price over the last month of data. The VXN is looking at what the best market movers think is going to happen the next month. The way we know that is, where are they putting their money on puts and calls on the NASDAQ 100? This is considered what are the pros thinking is going to happen in the next 30 days. That's one of the reasons you can use this as a formula to predict what's going to happen with the NDX, is that this VIX can be tied to the moves and swings of the NASDAQ quite well. The VXN volatility is explained here, and that's what we use in the VXN. Well, it's still down, but it's starting to rise, and it's bouncing around a little. So it's not doing enough to make me feel like we can tough it out. If it was completely low and not kicking up any, I'd say, let's wait another week and see what happens and stay in the market. But since it's starting to kick up, I'm going, well, I'm going to get out. Okay, this is the update on our 60/40 portfolio of short the VIX, long the VIX midterm, and that's the green line. So it's a 90 compared to the S&P, which is up at 108. So it's slightly below the S&P, but very much more stable, as you see how it was. And it had a little bit of a bobble there, but nothing like what the S&P went through. And then we have closed up to just what's been going on since 2022. And we're looking at that's actually in pretty good shape. And then we've added gold, which looks better than anything. Gold miners, which they're down here, but they've got this outrageous slope to them, coming up, screaming up, which it's a gamble, so I'm riding that and looking at it. And then this SVOL, the reason I have SVOL Yahoo is I have to get the data from Yahoo to add the dividends because that pays uh, between 16 and 17% a month dividends, and then plug that in. And you see that's up here at 24. So that has more volatility in it, but it's an interesting thing in that it's a fund that also tries to do short and long the VIX, along with some other things, a lot of long-term notes and corporate bonds to try to get 5 to 10% with corporate bonds, and then goose it a little with what's going on with the volatility. So an interesting fund. What looks good now for your 401ks? A lot of you are in a 401k where VIGAX is what you use. Go cash, 100%. The same with this, the same with this. Anybody just doing the Qs by themselves, or if you're lucky that's one of your picks, go cash. All of you over at uh, our friends at Cyber, sell the stocks, sell the commodities, commodities, and go to this is close to short-term bonds because you can't go cash. So Merlin Cyber, go as close to cash as you can with PRRIX. What do these look like lately? This is a 1 month. Everybody has turned and started to come down. There's only one that went up. And here's the bond fund for Merlin. It's as good as cash. It's okay. But with everybody coming down, everybody looking worse, except this is the insurance. It has some mutual funds in it that are a lot of corporate bonds, but in reality, it's just not doing good enough. So we go cash for a while and wait for the market to do something that makes us feel good about coming back into the market. And keeping up with our S&P and our QQQ, they've dropped this last week a bit off their peak. Gold hasn't done a whole lot. It's better than this. And then gold miners have been a wild ride, but still don't know if they're over that ride or just the start of another takeoff. So I'm still hanging on to that for a while. Now, the timing signals really haven't changed. They're still 66.6% buy, but we're still getting out, and I'll show you why. Start with the Russell 1000. It's come back and gone sell. The S&P is headed for a sell. The Nasdaq has turned over and is headed for a sell. So all three of these are headed for a sell, and that If I had any bluebirds here, I'd probably say, well, I'll stay in a little while longer and see what's going on. But I'm not convinced that we aren't going to just continue to see deterioration across the board here, which would lead fairly quickly to a sell for sure. But the thing of it is, it would be coming in about 2 weeks, but I don't have faith it's going to turn around. So why not sit cash for a while right now? Now, the detail of just our uh, QQQs, you see that's turned, come down. Here was the sell of our best formula, and it's a sell when that red line comes up and crosses a red line. It's a buy when the green line drops below that green line on the way down. So we got a sell, and the sell starts to drop. The green line starts to drop, but this would still be a few weeks away from being a buy. But before it's going to be a buy, you see that the sell has already turned around and started back up again. Well, with this coming back up, it's going to beat the buy signal. We're going to get another sell signal, which, if you think about it, that means we really should have not tried to bounce back in here. Now, this one, in most universes, it would have touched here and we'd have been on a sell anyway. So I was only on a buy there as long as it looked like we would have a recovery. But again, doesn't look like it's going to happen for a few weeks. Might as well get out. So that's why I don't have any bluebirds to make me feel like we're going to make a whole lot of money over the next couple of weeks. We might as well sit cash in case this difficulty gets wings and starts to drop faster.